We're going to have a look at the balance sheets in published accounts, and again it's the 2013 exam paper. So we look at the balance sheet of Moorfields PLC, public company, as on the 31st of December 2012. Try to remember that your balance sheet is always as on, whereas your final accounts will be for the year ending or whatever period they relate to. We start off with fixed assets, and we have three categories or classifications. We have intangible, tangible and financial. Intangible fixed assets would be, things that you can't see or touch, but they're earning an income for the firm, and typically would include things like goodwill, trademarks, and in this case patents is €30,000. The trial balance entry is 36,000, and we've written off 6,000 for amortisation, and that brings us down to 40,000. The adjustments tell us that the original cost was 60,000, but we're not showing that here, just the written down value of 30,000. Then the tangible assets have a note on them. See note, whatever it is. We'll be coming back to that later on, where there's a full explanation of where the figure comes from. But in this case, we've got vehicles, 116,000, buildings, the revalued figure of 970,000, and that gives us 1,086,000 for tangible fixed assets. 1,086,000. And then for financial fixed assets, we've got investments, and we always enter those in our balance sheet at the original cost. So the financial fixed assets would be in at 300,000. It's also common to have a note on those because it would probably be necessary, it is necessary, to show the current market value of those investments. And that brings us down to current assets. And according to the Companies Act, in relation to current assets, we have just three categories. You have stock, debtors, and money, bank. We have stock worth 85,000. It's just a single item in this case, but remember, in a manufacturing firm you could have raw materials, and you could have finished goods and work in progress. And of course you could also have, in any firm, stock of stationery or stock of heating fuel or diesel or petrol or something left over at the end of the year. And all of those would be aggregated, they'd be all added together, and you'd put in a single figure for stock in the balance sheet. In this case here, it's just one item, 85,000 worth of finished goods left over at the end of the year. Debtors, in this case, in published accounts, debtors refers to anyone who owes you money. So it's not just your trade debtors, which are worth 240,000 in this case, but you also have less the provision for that, it's 12,000, and you've got investment income due to the firm of something like 9,800. Anyway, that gives us a debtors figure of 235,300. And then bank would refer to any money that the firm has, other than any money invested. Any money the firm has, it could be cash in bank, cash in hand, could include deposit accounts. In this case, it's just a trial balance bank figure of 57,800. And as always, we add up our current assets, and that's giving us here 378,100. And we take from that then our current liabilities are our creditors due within 1 year. Avoid calling them current liabilities, because you'll be Dr. Mark for that. Call it creditors due within a year. And again, what you can write down in your published balance sheet is limited to, in this case, just three. We've got trade creditors. These are the people who supply you with your goods, and our trade creditors are 184,000. We have taxation. Now that's any tax that the firm owes. In this case, it's 60,000 for corporation tax and 74,000 due on VAT. In here you could also have your universal social charge due, or PRSI or PAYE, any taxes owed by the firm. But as I said, in this case, it's just the corporation tax and the VAT, totaling €134,000. And then you have other creditors. That's really anyone else to whom the firm owes money. That's 43,500. In this case, it's audit fees 6,500 due, directors' fees 35,000, and we owe interest on debentures of 2,000, and that's the 43,500. You're probably going to find in future marketing schemes that they'll be a bit stricter than recently, and you'll be restricted to putting items only under those headings and a single figure in each case. So the total for our liabilities falling due within a year is 361,500. 361,500. And we're subtracting that from our current assets there. Our current assets are 378,100. So that's going to give us what they call net current assets. We might normally call that working capital, but in published accounts the terminology that's required is net current assets, and it's at 16,600 here. So now we have our intangible fixed assets, our tangible fixed assets, the financial fixed assets, and the net current assets, and that gives us then our total assets less current liabilities. Again, that's the terminology of published accounts. It's total assets less current liabilities. You may be used to calling that net assets or total net assets, but again, total assets less current liabilities, and that's 1,432,000. And then we go to the finance side of the balance sheet. Again, this must be presented in a particular way. One of our creditors due after 1 year, and in this case here it's our 5% debentures. Moorfields owes the debenture holders €200,000. And then we have capital and reserves. And this is simply the issued shares. And that's the sum of the preference and ordinary. So we have 650,000 worth of issued shares. In your internal accounts, you are going to show the authorised and the issued share capital and a breakdown of that there. But in the published accounts on the face of the balance sheet, just the total for the issued share capital is 650,000. And then we have our reserves. We've got the revaluation reserve. That was the surplus we made on revaluing our premises. And that amounts to 158,100. And we've got the profit carried forward. That's the P&L balance at the end of the year. Our profit carried forward is 424,500. So our total there is 1,232 for the capital and reserves, 600. And the total for that side of the balance sheet then amounts to 1,432,600. With no name on it. We would normally be calling that capital employed, but it's not required in published accounts. So a quick recap there for the balance sheet. You have your typical heading. You start off as always with fixed assets, and then you give a single figure for the book value of the intangibles and the tangible assets and the original cost for financial assets. There are always explanatory notes for the tangible and the financial fixed assets. We'll deal with those later in the next session. Our current assets, again, just the three categories: stock, debtors and bank. Less the liabilities falling due within a year. Again, the published accounts restrict you to particular terminology: trade creditors, taxation and other creditors. You take your liabilities falling due within a year from your current assets, and you get your net current assets. As we said, what the thing you normally call working capital, net current assets, and the total of the asset side of the balance sheet being referred to as total assets less current liabilities. It will vary from year to year in regard to what penalties might be imposed for using inappropriate terminology here, or in showing extra figures that are unnecessary in the balance sheet. So you really are better off getting familiar with the proper sequence and terminology and the restrictions on what's shown and what's not shown. And then our finance by side, we have our creditors due after a year, in this case just the debentures, and then the capital and reserves. There is no mention here of shareholders' funds, or there's no distinction between ordinary and preference shares. It's worth remembering though that the revaluation reserve is a capital reserve, and in recent marking schemes there is a requirement to put that on the capital side of your shareholders' funds. If you put revaluation reserve on the other side of the P&L balance, you're probably going to lose a mark or two. So the idea really would be that the capital reserve, which is what revaluation reserve is, it's a capital reserve, that's added to your share capital, and then you'll add in your revenue reserve, your general reserve, you know, your P&L balance. And all that remains to be done now for the 2013 published accounts is to have a look at the presentation of the notes, and we'll go on to that next.